Okay, can you see this?
Yes, I can see.
Okay, so your question is about this exercise or activity 13.4. Obviously they gave you debt and equity, they gave you tax, and then they gave you this. They said the risk-free is 6% and the market risk premium is 5%. Okay, when you see market risk premium, the market risk premium is already the answer when you take the market return minus the risk-free. So you could actually work out the market return, because here risk-free is 6%. So if the market risk premium is 5%, that means the market return must have been 11%, because 11 minus 6 must give you 5.
Yes, sir.
Okay, so the market risk premium is actually the answer already here, which is just 5%. You don't have to put in a market and a risk-free. Because they spoke about the premium. The premium is what's additional, what's more than what the risk-free is.
Yes, sir.
Okay, so that's why they've done it that way. Okay, they haven't shown market minus risk-free. They've just shown 5%, which is representing that answer already.
Yes, sir.
Okay, does that make sense?
Yes, it makes sense.
Okay, good.
I understand.
Alright, so that's just an answer to that question. I'm glad that you've been revising and going through some of the material. You probably will get questions about CAP-M in the exam. It's a common question. So you do need to be familiar with the formula going into the exam. Know that it's risk-free plus beta times the market return minus the risk-free. Okay, just remember that the risk premium could be the actual bracket part, okay, meaning the market minus risk-free.
Yes, sir.
Okay, so let's see how you did with May-June 2016. Right, last week you actually, I think you might have done it for last week, but last week we covered October-November 2016. So May-June 2016 is what we're looking at tonight. Okay, just to make sure that you are comfortable with all the workings. Okay, remember, exam technique is important. It's a 2-hour paper. It's out of 100 marks. So what I would be doing is I'd be looking for easier sections that I could do without too much hassle, and to build confidence as well in the exam. Okay, remember you want to watch your time as well, because this is a 2-hour paper and there's 5 questions to get through. You need to stick to the time allocation. So you've got 12 minutes for the multiple choice, 19 for question 2, 32, 33, and 24 minutes for those questions. Looking at the proposed timetable, I want to find questions that have ratios, because obviously you would have studied all your formulas going into the exam, because they don't give you a formula sheet. You're going to have to know them. So like things like current ratio, quick ratio, your average payment period, all of those ratios, inventory turnover. You need to know what they are in terms of numerator and denominator. So I would actually start with that. Why? Because I'm fresh, I've studied my work, so going into the exam I should know what those formulas are. So I would go to question 4 just to have a look at what they're asking me to calculate. Here's it. There's question 4. Okay, they want you to calculate operating profit margin. They want you to calculate return on assets. Remember, with return on assets, there's 2 ways of calculating it. You can use DuPont, okay, because DuPont is part of, or let me put it this way, ROA is part of DuPont. Okay, when you take the net profit margin times the total asset turnover, that actually gives you the return on assets. Okay, so you could use that. Then they want the financial leverage effect, and they want the debt ratio. Right, so whether you do this question or not, it's totally up to you. Okay, I would actually start with it purely because you should know what those equations are currently when you start the exam, because you would have studied the formulas going into the exam. So you'd rather write down the equations first, so at least you don't forget them. Okay, because now if you do question 1, question 2, question 3, now you get to question 4, you're probably tired, you might be a little bit maybe stressed about time, and then it might be difficult to recall what the actual equations are. And that's my only reason for starting with it. So that's what I'm going to start with in this paper. Remember, it doesn't matter where you start. Okay, obviously this is a written exam, so you are going to have to record all your workings, show your calculations, show your equations, and so on. So So you are going to get marks for formulas. So it's definitely worthwhile starting with this question. And it's out of 27 marks. It's a lot. And it's easy so long as you remember what the equations are.
Yes, sir.
Okay, so let's start with this question. Operating profit margin. I'm going to go to the textbook and just copy the nice, well-written formula. So we've got it here. I'm looking for profitability. Here's it, gross profit margin. I'm looking for operating profit margin. Okay, so this is the formula that you are going to need in order to do this question.
Yes, sir.
So I'm going to start with question 4. This is actually C though.
Yes.
Okay, there's still A and B. You can see A and B's theory.
Yes, sir.
Okay, like define the SWOT analysis. That's simple. That's strength, weaknesses, opportunities, threats. B, classify the internal and external factors of HHY construction into the SWOT analysis approach. Okay, that's obviously taking what information they've given you and then identifying whether this is a strength or a weakness. Okay, so we'll do that just now. Let's first start with C so we don't forget the equations. Question 4C. Big heading, label your questions carefully so the examiner knows which questions you're answering. And then I'm going to start by calculating operating profit. They say 3 marks for the formula. Look how much the marks that is. 3 marks just for the formula. And then 2 marks for the calculation and the discussion. Okay, so copy your formula, write it down. There's it. Operating profit over revenue is going to give you operating profit margin. Right, so now what do? I'm going to shrink this and then just put this up. Let's go and find the operating profit margin. Where is it? Okay, that's the continuation. Question 4 starts here. Okay, question 4. 27 marks, 33 minutes. They've given you HHY construction. Then they've given you a list of internal and external factors. We don't need this for the accounting ratios. So I'm not going to worry about this now. I'll worry about it later when I look at the theory. Question 4, statement of profit and loss. This is something that I need. Okay, so I'm going to require the operating profit. There's my net operating profit or loss. What year are they asking me to calculate? Let's go back to the question. C says, calculate the following ratios for both years, 2015 and 16, and state whether there was an increase or decrease, and briefly present a realistic reason for the change as well as a possible implication of the change. Okay, so the first bit is to work out operating profit over revenue. Let's move that up. Okay, operating profit there. Okay, so 2015, 2016. 2016's formula is going to be operating profit 6639 divided by
27002.
Correct, 27002 times 100.
Yes. Equals 27.59.
20. I got 24.58. Did you work it out correctly?
I believe so. So let me just try again.
Okay, check it again, and then we've got 2015. 2015's formula is operating profit 8885 divided by 25668. Okay, I get 34.61 there. Right, we need to talk about increase or decrease. So what happened? The operating profit margin has decreased from 2015 to 2016.
Yes.
This is bad. Well, this is negative. Okay, we want this ratio to increase. Obviously, that's ideal. Okay, then the question says, give a reason why. Well, looking at this, revenue has gone up. Do you agree?
Yes, sir.
Okay, but your operating profit has gone down. So that means your costs have gone up a lot. And you can see that by looking at the extract of the statement. Okay, that's just looking at your accounting knowledge. Okay, so reason. Revenue has increased, but operating costs have increased a lot more than the revenue. Operating profit has decreased. Okay, so you could maybe talk about inefficient operations, poor operating management, or poor operations, brackets, more costs, not managing operations correctly. Okay, so you've increased your revenue, but you've increased your costs, and your costs have gone up a lot more than your revenue. Okay, you can see there's a big amount of other expenses here. Okay, last year you had only 102 other expenses. Now in 2016 you've got almost 9 times, or actually 10 times, okay, almost 10 times as much other costs that you had last year. Okay, so something's going on in this company. Okay, they're not managing their costs. Got that?
Yes, sir.
Okay, did you check your working? Did you make a mistake with the working?
Yes, sir. I just made a mistake. I put a 7 instead of a 4.
Ooh, okay, yeah, be careful with things like that, eh? You don't want to lose easy marks in the exam for calculation errors. Okay, 2. Return on assets. Calculate based on closing balances. That's what they've asked you to do. So we're using closing balances. 3 marks for the formula, 2 marks for the discussion. Okay, so ROA, again, you would go to your memory, okay, or you would go to your textbook, either or. Right now, obviously, I'm using the textbook formulas, so they're accurate and they're well laid out, and you can see what the actual equations look like. Obviously, you're going to have to write this down in the exam to get your mark for it, and this is what the equation looks like. Okay, the key formula for this ratio is EBIT over total assets. Okay, you could use DuPont if you wanted to. Okay, ROA is also net profit margin times total asset turnover. That's also another formula that you could use. So it just depends what the question has given you. But obviously I saw earlier that they gave me the income statement, okay, so I can see EBIT there, there's it there. Okay, so there's no need to use DuPont if I've got everything laid out nicely in this particular question. Okay, so same story applies here. 2 calculations for each year, 2016, 2015. Okay, it's EBIT. So 2016's EBIT is 7529. Divide by. Then I need the assets. Okay, I'll go get the assets just now. Let's just put in the other one as well. Okay, 2015's EBIT is 9769. 9769. Okay, then let's scroll down and let's get the total assets. There, the total assets.
433. Yes.
37433 times 100.
It was 20.11.
$20.11 is correct. Good. Okay, and then this one, total assets 31668 times 100.
$30.85.
Correct. Good. Okay, so what happened? Again, it decreased. This ratio has decreased. Okay, this is bad. Okay, let's describe why. Well, let's look at the ratio. Well, you can see 2015 I had 9769 in terms of EBIT. Notice that has dropped. Okay, so EBIT has decreased a lot compared to 2015. Okay, we can also talk about assets. What has happened to our assets? Well, the assets have increased. Okay, so you've made the denominator bigger, so the fraction will be smaller, obviously. Okay, so more assets in 2016 compared to 2015. Bigger denominator. Okay, so those are different reasons why, okay, the ratio has changed. Okay, because you've increased your assets. That's a good thing. There's nothing wrong with increasing assets. Okay, but remember, we're not looking at liquidity or solvency. We're looking at this, return on assets. Okay, so if we're just focusing on the return on assets, the ROA has decreased. This is a deterioration from last year. Makes sense?
Yes, sir.
Okay. Let's look at number 3.
ROE.
Yep, no, not ROE. Financial leverage. Okay, they gave you ROE, but they actually talk about financial leverage.
Oh, yes.
Okay,
Sorry.
so financial leverage can be calculated using ROE. So they're not requiring you to do 2 calculations.
Yes,
because
sir.
normally, if you wanted financial leverage, you're going to have to use ROE to you'd have to calculate ROE first in order to get the financial leverage. Okay, here they just want the financial leverage having given you the ROE. Okay, so financial leverage effect is ROE to ROA. That's the formula. Okay, so this is what we need to write down in our answer sheet. There's the formula. Financial leverage is ROE to ROA. Okay, do I have my return on assets? Yes, I do. Return on assets came from question 2, right?
Yes, sir.
Okay, so all we have to do literally is just take our answers from question 2 and insert them in question 3. Okay, so in 2016, ROE was 26.38, and that would be to 20.11.
20.11, yes.
Okay, and then in 2015, you had ROE of 4.4545 to ROA of 30.85. Okay, there's it there. Right, then obviously you would simplify. Okay, you'd get a number, so you would divide the one number by the other, and you would then get a figure. So let's check. 26.38 divided by 20.11 gives me that to 1. Does that make sense?
Yes, sir.
Okay, then 44.45 divided by 30.85 gave me that. Right, so looking at this, has the financial leverage increased or decreased?
It has decreased, sir.
Yes, financial leverage has decreased from 2015 to 2016. Okay, obviously there was more financial leverage last year than there is this year.
Yes.
Okay, remember financial leverage is looking at the return on equity compared to the return on assets. Okay,
Yes,
remember
sir.
your assets are financed through what? Debt and equity, do you agree?
Yes, sir.
Okay, that's the financing part of it. Okay, so you can see if I look at my financing, okay, my assets have obviously increased, right? If I look
Yes,
at my liabilities, okay, so they didn't give you total liabilities, they gave you current and non-current separately. Okay, so there's current, non-current, and there's current. Okay, so looking at this, you can see that liabilities have increased. Do you agree?
Yes, sir.
Okay, so our liabilities have increased, and so has our equity. Right, so you've obviously needed more finance in order to buy more assets. Okay, assets require funding. So in order to buy more assets, I'm going to require more funds. Okay, but we
Yes.
know that looking at the performance of the business in terms of profitability, okay, the EBIT has decreased, and so has the net profit. Right, so are
Yes,
you
sir.
earning more or less? You're actually earning less
Less.
with the assets that you've got. Okay, that's quite strange. Okay, you would think that you would think that having more assets would earn more
More
profit,
profit,
revenue.
make them more efficient, yes.
Okay, so the revenue has gone up, but we saw that the costs were not controlled. Okay,
Yes,
so
sir.
looking at this, financial leverage decreased. Okay, why? Well, the company needed more capital, brackets debt and equity, to purchase or to acquire more assets. The assets have increased, but EBIT and net profit has decreased. Okay, so if we look at financial leverage, remember leverage is doing more with less. Okay, that was theory that we looked at in the textbook. Okay, remember leverage is being able to acquire more resources and to do more with those resources. So financial leverage is looking at, well, with the resources that you have, okay, with the debt and equity that you're using to buy assets, what sort of return are you generating in terms of your return on equity? So return on equity means the return that our shareholders are getting, okay, versus the return that we're making on the actual assets. Okay, so looking at this, you can see that the return that the shareholders are making compared to the return on the assets have actually decreased.
Yes.
Okay, so shareholders are paying more for financing assets but not receiving more return. Okay, so more funding is being used to grow companies' assets, but this is not translating into greater profitability, as the operational side of the business is problematic. Okay, costs have increased, which offsets the benefits of increased income and ultimately more profits. Okay, so there's no point buying more assets if you're not going to use those assets to generate more income. Okay, in this case, they are using the assets to generate more income, but they're not controlling their expenses, their costs. Okay, so it's definitely an internal issue that needs to be investigated. Okay, obviously from a management accounting point of view, you would look at operational things. Okay, you would look at how is the company operating. Okay, because that's where the problem lies in this particular business.
Yes.
Okay, 4, debt ratio. Right, so debt ratio is looking at liquidity and solvency. It's basically looking at your gearing. Okay, how over indebted is this particular business? Okay, how much debt do we have compared to its assets? Okay, so debt ratio, total debt over total assets. 2 years again. Let's go to the question. Okay, here you're going to have to do a calculation for the total debt. Okay, so for 2016, you're going to have to add the current plus the non-current. So total current liabilities was 18077 plus total current liabilities 4817, close brackets. Divide by total assets, which were 37433. Okay, times 100. $61.15. That's the debt ratio for 2016. 2015, 16959 plus 4006. Divide by 31668 times 100. $66.20. Okay, so looking at the debt ratio, have things improved? Yes.
Yes, sir.
Okay, so basically you're looking at liquidity here in terms of is the business more solvent or less solvent, or more liquid or less liquid. Obviously we're looking at total debt over its total assets. So the total debt over total assets has actually decreased because you've got more assets but you've got less liabilities, okay, compared to last year. In other words, more equity is being used to finance assets in the business. Okay, we don't know what the risk profile is of the business. You could talk about being more aggressive or conservative. Okay, if the business is conservative in nature, then obviously this is a good sign because they've decreased the debt ratio. If the business is more aggressive, then this would be a bad sign because you would want more debt if you were an aggressive business, because then you're looking at using other external finance in order to grow your assets to increase your operations. Okay, so that's something that you could maybe discuss if you have more information in the question. Right, but they just told us to comment and maybe to explain why. So we can say greater assets, finance more so by equity rather than debt. Okay, debt ratio has decreased slightly. It's still quite high though, 61%. Okay, that means 61% of your assets are financed through debt. Okay, it's less than 100, which is still fine because that's not overextending the business. Happy. That's 1, 2, 3, and 4. Okay, how much was that out of? 19 marks. That's a lot. Okay, 19% just for doing that. Got that?
Yes, sir.
Okay. Let's go back to those two theory questions. Just to answer them and to finish question 4. A and then B. Okay, obviously B is looking at the actual classification of the different internal and external factors. A is defining the SWOT analysis. Okay, so we know SWOT analysis is looking at strengths, weaknesses, opportunities, and threats. That's all it is. Okay, it's theory that comes out of your textbook. So I just want to give the correct, let's say, definition. Okay, so I'm going to take the definition from the textbook in terms of SWOT and how they define it. Okay, in the glossary, this is what I've got here for the SWOT. This is how they describe it. Okay. I think that's enough in terms of 2 marks. I don't think they would want more than that. They might, depending on their mark allocation or their memo. So maybe just to get something else from the actual chapter, study unit 4, page 30. They give you an overview here. They give you SWOT. They say from the above definition, they talk about strength, weakness, opportunity, and then they relate that to internal, external factors. Right, so this comes from the actual textbook. You might want to add more to that description if you want to. Maybe just to add more depth. Okay, but I think it's fine, that definition from the glossary. It shouldn't... it's for 2 marks, so I don't think they want that much, but you never know. Okay, so that's what you've got there for strength, weaknesses, opportunities, and threats. Then they say classify the internal external factors of HHY into the SWOT analysis approach. Answer the question in the table format as illustrated on the next page. Okay, so this is what they want. Right, so I'm going to take what they want us to do here. Okay, so I need to illustrate this in this format. Okay, so they want me to draw up a table. Okay, they want the internal factors. Okay, then I'm going to list them. And then they want the external factors. Okay, so positive SWOT factors, negative SWOT factors. Then positive SWOT factors, negative SWOT factors. Obviously, you've got 2 different groups, internal, external.
Yes, sir.
Okay, so remember, positive relates to opportunities, and strengths.
Yes,
Let's go
sir.
to the question. Where's the question? There's it. Okay, so let's see what we've got. HHY Construction is a long-established company, respected throughout the construction industry with vast experience in civil engineering and groundworks. Okay, that's already a strength there. Vast experience. That means they're established. That's good. During the past year, their management became aware of a decline in revenue and profits, which was confirmed by the financial statements of Feb. Okay, we saw that. Okay, there wasn't a decline in revenue, so I don't agree with what they said here. They said during the past year, their management became aware of a decline in revenue. Revenue didn't decline. That's not a decline. Do you see that?
Yes, sir.
Okay, so I don't agree with what they say in the question. Revenue has gone up, it hasn't gone down. I agree with profit being affected. Okay, profit has gone down. This has gone down. This has gone down. That has gone up.
Yes, sir.
Okay, so that's a problem with the question. Okay, then they say they decide to revise the strategic approach as well as to do an analysis of their financial information. Fine. Okay, so this is what they've given you. Right, so list the internal and external factors applicable. Okay, so this is what we've got. We need to obviously put this in a list. Let's read the first one. HHY strengthened their vertical integration with the acquisition of Torsas, South African major asphalt supplier, and also diversified with the acquisition of LA Civil. Okay, that's good. Okay, that's mergers and acquisitions. Okay, they've acquired, this is a vertical integration. Okay, so they've literally bought one of their suppliers, and that'll definitely help the company. Would that be internal or external?
That would be internal, sir.
Okay, it's internal because this business is now part of the company.
Yes.
Okay, so I would also agree with this being part of that. So number 1, point 1. Okay, you would put that over there. Okay, I don't know if they want you to write the whole thing. They might. Okay, I'm not going to write the whole thing. That's just a waste of time. I'm just going to say point number 1. Okay, then obviously this is an answer to this. Okay, so point number 1, point number 1. Is that okay?
Yes, sir.
Okay. Alright, number 2. With the acquisition of Torsas and LA Civil, some complications regarding employee dissatisfaction came to light. Okay, obviously in a merger or acquisition, okay, you've got companies buying other companies, right? And remember, if one company buys another company, you can't have two CEOs. Okay, so
Yes.
if you're acquiring a company, the CEO of the company that you're acquiring is going to have to report to the holding company. Okay, so
Yes.
HHY is actually the big brother, okay, and they've acquired Torsas. Okay, so obviously Torsas is under HHY. Okay, so that has created some dissatisfaction. Okay, so that's definitely a negative, and that would be internal as well. Do you agree?
Yes, sir.
Okay, they're not happy with what happened. 3. During the past financial year, a process of unbundling helped strengthen the competitive spirit and would help HHY through tough future years when infrastructure spending is at a low. Okay, so this is obviously looking at the process of unbundling helped strengthen
Sir.
the competitive spirit. Okay, this was during the past financial year. Unbundling is when you're selling stuff. Okay, but when looking at selling stuff, did they sell anything here? Let's see. The assets went up. Current assets went up. Inventory went up. Okay, maybe
So
the
that's-
unbundling is referring to the acquired company, perhaps. Okay, so the
Yes.
acquired company being bought out. Okay, here they're talking about the process. Okay, of unbundling helped strengthen the competitive spirit. Obviously, if we're focusing on the effect, okay, so obviously something happened, unbundling, okay, strengthen the competitive spirit and would help HHY through tough future years. Right, this would
Internal.
definitely be internal, external.
Internal, positive.
Internal, correct, because it's looking at the competitive spirit within the organization.
Yes, sir.
Correct. It's positive because if people are more competitive and they're going to be doing more for the business as a whole, that would help the business grow. 4.
Yes.
The unbundling was an expensive process which had a direct effect on the company's net profit. Okay, that's obviously internal. We saw the profit decrease, so that's bad.
Yes.
5. HHY generates approximately 10% of its revenue outside of South Africa, and new prospects may arise in the future. Okay, notice they're talking about something that's outside of South Africa, so outside of the country. Okay, and new prospects may arise, which is an opportunity, but it's external.
Yes, sir.
The new business in Africa increased revenue in the 2016 financial year, but resulted in higher outstanding debtors and current provisions. Okay, so looking at this is new business in Africa, increased revenue. That's internal. But results in higher outstanding debtors and current provisions. Is that correct? Let's check that. Where's the debtors? The debtors go up? Yeah, the debtors went up. Okay, we don't have information about the provision, but they've told you that in the information in the question. Okay, which is not a good thing. It's internal. So it's difficult to say where you should put this because they talk about the increase in revenue, which is good, and then they talk about the increase in debtors, which is bad, and the current provision from a financial management point of view.
Yes.
Okay, so I'm going to write down two things here. Point 6 brackets increased revenue is good, and then point 6 here, increased debtors and provisions negative. Why? It affects cash flow. Okay. Right, so I don't know if you're allowed to do that, or do they just want you to put 6 in one of the categories? Okay, but you can't really in this case because increasing revenue is good, increasing of that is bad. So I can't put the one in the other. Okay, so I'm going to answer it like that. Is that okay?
Yes, sir.
Okay, point 7. Trained and skilled contractors are on hand to carry out excellent workmanship. HHY takes pride in. Okay, obviously that's a strength. It's internal. It's people working within the organization.
Yes, sir.
Industry trading conditions in South Africa construction industry weakened due to a capacity surplus created during the World Cup preparations. Okay, that's obviously external. That's negative.
Negative. Yes.
8. Industry trading. Oh, that was 8. Sorry, wrong number.
This is 9.
This is 8. It's 9. Okay. During the financial year, the process of unbundling will be reversed, and HHY will be restructured into 3 divisions. Currently, the company is showing rapid growth in the road rehabilitation sector. Okay, so obviously they're in the construction industry. They're looking at a process of restructuring this company into 3 divisions. That would be internal. The company is currently showing rapid growth in the road rehabilitation sector. So that would be also internal. So unbundling will be reversed out and will be reconstructed in 3 divisions. Looking at this, I would say this is a positive rather than a negative because they're saying that there's rapid growth in the one sector. So if you're creating 3 different divisions, if the divisions are decentralized, they would be able to operate more effectively.
Yes, sir.
Okay, so I would go with this as being more a positive than a negative. But at the same time, it can create problems as well. Because if you have different divisions, then that's additional management, additional oversight, additional supervision, all of that stuff. Okay, but I don't have any information other than showing rapid growth. So showing rapid growth is good. I would go with positive here.
Yes, sir.
Okay, 10. HHY prepares for strong future growth by bringing together experience, expertise, and talent. That's definitely a strength.
Yes, sir.
Internal. 11. From May 2016 onwards, the company would like to take on larger road construction products and start venturing outside its original groundworks. Okay, that's good because that's positive. If they're taking on larger projects, that's good because they've obviously built the business if they've acquired a company. It's an external factor which would be positive. Okay, but at the same time, it could be negative as well if they can't manage with capacity.
Yes, sir.
Okay, but I don't have additional information here. They just say they're starting to venture outside, which I would say is a good thing because you're diversifying, you're growing the business. It would be seen more as an opportunity rather than a threat.
Yes, sir.
12. HHY has identified a large number of road construction machinery that is in the final year of its economic life. Ooh, see, that's a threat. Why?
Yes.
Well, it's internal, okay, but it's a threat to the business's ongoing operations because old machinery means less efficiency, right?
Yes, and they don't need to buy new ones.
Yes, or they're going to have to maintain the machinery, and that means more cost. So maybe that's why. Maybe that's why their costs have gone up.
No, yes.
Because they need to maintain the stock now. Well, not stock, they need to maintain old machinery. Okay, it breaks down. Now you need to repair all the stuff. Okay. 13. The developing road network requires a large number of bridges, and HHY wants to be there to build them. That's an opportunity.
External positive.
Yes. Last one, HHY acquired new bridge construction equipment in January and funded it through bonds. Management is concerned about high debts and cash flows. Okay, that would be something good and bad again. Okay, buying new equipment is good, but financing it through bonds, high concern for debt and cash flow, this could be more a threat than an internal factor because high debt would be because of the interest factor. So I would split this as well, but I would split it here, brackets, new equipment, that's good, that's internal. Okay, and then I would also put that here as external, higher debts, possible interest increases. Okay, and also outflows, a concern. Okay, that would be more a threat. So I would split it like that. Point 14 I would put under two headings. Okay, and that's question 4.
No, isn't there a last one? Yes, actually, yeah, you're right. So that's the end of question 4.
Sorry, what is that last one? Yeah, 14 went here and there.
Yes. No,
is that alright?
Yes, sir.
Okay. Let's go back to the proposed timetable. So now I've completed question number 4 because I've studied and I know my ratios and I've spent time doing the longest question. Okay, you don't have to start with the longest question. The longest question here wasn't actually that difficult. Okay, why? Because it was ratios. You just had to know what the ratios were, and then you just had to remember what SWOT was, and that was it. Okay, so normally longer questions are more difficult, but not always the case. It depends on what they're testing. So if they're testing something like SWOT, or if they're testing something like ratios, then it's actually not that difficult.
Yes, sir.
Okay, so let's start from 1 and let's just go through the rest. I'm going to start from 1, then do 2, then do 3, then do 5. Okay, it doesn't really matter which order you do this past paper in, so long as you label everything correctly. Okay, so question 1 now. Multiple choice, MCQ. How many questions do we have here? Probably 5. Yes.
Yes, sir, 5.
Okay, so let's shrink this again. Okay, number 1. Which one of the following alternatives relates to the 4 risk management standards or approaches? Okay, this was looking at the risk management chapter that we had at the end of the second textbook, where we had the Aussie New Zealand approach, we had the CIMA, we had the IRM, IRM, the Institute of Risk Management, and we also had the COSO. Okay, Committee of Sponsorizing Organizations of Tradeway Commission. Okay, so risk management approaches. CIMA, yes. COSO, yes. Australia, New Zealand, and I would go with C here. Did you go
sir.
C as well?
Yes, sir.
Okay, page 169. 1.2. Statements regarding factors that will influence risk. Okay, this is looking at risk in terms of the influences on the actual risk. Okay, what influences risk? Okay, number 1 says non-compliance with regulations or internal procedures. If you're not complying with internal procedures, that would non-compliance with regulations. Yeah, that would definitely increase risks. That's non-compliance. Non-compliance meaning we're not following the rules. Do you agree?
Yes, sir.
Okay, so if we don't follow the rules, that would create risk. But say here, indicate which combination of the above statements are factors influencing strategic risk. Okay, but this is strategic risk though. So
yes.
Strategic risk is looking at strategy. That's looking at what are we trying to achieve long term. That's more like the goals. Okay,
yes,
so maybe number 1, non-compliance with regulation. That's more operating. So not the best one. Research and development capacity. That would affect your strategic risk because new research and development of new things would affect it. So 2 is definitely correct. 3, business interruptions. Business interruptions would be more operating rather than strategic. So I don't like 3. 4, flexibility of production processes when product specifications alter. If you're altering product processes when product specifications alter. Product specifications is looking at what do you actually want to do with that product. So that's the goal, that's the objective, that's the long term. Okay, so if your strategy is to provide something different, then this would be part of it. Yeah, so 4 is looking good. So 2 and 4. Actions of competitors that would affect your strategy. Significance of new technology that would affect your strategy, because obviously new technology means new developments. Okay, so 2, 4, and 5. A.
Yes.
Page 178. Theory that you can go over. Okay, this one's number 3. Number 3, only 4 options. Okay, great. Okay, so here we're looking at that pestle. Pestle analysis is a method to identify risks. Which one of the following alternatives is the correct description for this analysis? Okay, this is looking at your glossary of terms. Okay, the correct answer is an analysis of all the political, economical, social, technological, and ecological and legal factors that affect the organization. Okay, so breakdown of all. A group that tries to find the solution. Techniques involved? No. Risk of to break down into components? No. I would go with the D.
Yes, sir.
Okay, what page did I get that from? 190.
193.
Okay, I actually got it from page 190, but 193 is probably right as well. Okay. 1.4. The following terms refer to goals and outcomes of strategic planning. Okay, this is looking specifically at strategic planning. So planning meaning we're trying to focus on things that are going to affect us going forward. Okay, strategic planning meaning what plans are we going to put in action that will affect what happens in the future. Okay, so here they say which one of the following statements is not true. Okay, so goal hierarchy has to do with the allocation of resources. Goal hierarchy is looking at where do you have the goals in terms of importance. It's not really looking at allocation of resources because if we think about it, refers to goals and outcomes of strategic planning. Strategic planning, goals and outcomes. If I'm planning, then I want goals with the allocation. Okay, maybe, because if you're allocating resources, depending on what your goals are, then you would probably allocate resources differently. So, possible. Let's read the others. A principal goal when drafting a strategic plan is to develop it in such a way that it can be easily turned into action plans. Okay, well, you would definitely want to take action. So if you have a goal, you would want to implement the goal. So you would want to do something about it. Goal congruency has to do with how well different goals blend with each other. Goal congruency, I think that was looking more at the long-term goals. Let's just check that.
Page 28.
Goal congruency. First book or second book?
First book, page 29, actually.
Okay, let's go back to the first book. Let's search for goal congruency. Okay. Goals and outcomes of strategic planning. I've got this on page 29. Is that where you got it as well?
Yes, sir.
Okay, so yeah, goal congruency has to do with how well different goals blend together. Goal congruency is how well different goals blend with each other. That's correct. Okay, the goals hierarchy, we said that was correct, but this is allocation of resources. Goal hierarchy has to do with the inclusion of one or more goals. Okay, that one was the wrong one. Okay, so A is not true. Let's just check the others. A principal goal is when drafting a strategic plan to develop in such a way that can be turned into action plans. Oh, that was definitely correct. D was looking at goal sequencing. Goal sequencing entails one goal and obtaining the next goal. Correct, yeah. So it all comes from the textbook. Page 29 is correct. That's the right reference. The first one was the hierarchy, having to do with allocation of resources. Okay, so I was undecided with that one. We had to look at the others to confirm. So just to double check on page 29, option A is false. Okay, which one of the following statements represents the link between the vision statement and the strategy? Okay, that's the link. So the link means what combines the two. Vision and strategy. Vision statement gives a clear picture. In other words, what the organization wants to become ultimately in the future. It represents the strategy. But they want the link between. Strategy is about choosing long-term activities. Vision statement. Mission statement defines the core purpose of the organization by broadly stating the strategy of the organization. I'm leaning towards mission statement, but let's just double check. Vision statement. Okay, the vision statement defines where the organization wants to go in the future. That's what the definition is. Here they want the link between. Okay, let's go mission statements. Let's find that. An organization needs to know what it does, why it exists. Mission statement. It needs to dream the dream for the future, vision, and employees have to know what their behavior, core values, to reach its dream. Courses of actions, bracket strategies, are chosen to realize the vision. Yeah, this could be the link. A mission statement. Okay, then on page 6 they describe what a mission statement is. It's just the core purpose of the organization and why. Okay, so let's look for another one. Let's look for vision statement. I checked. Let's check strategy.
They're on page 7 and 8.
Yes, I've got strategy here. What page is this on? Page 8, yes. Okay, so strategy on page 8 says, the term strategy has different meanings for different people, making one definition almost impossible. We have therefore provided a simple definition of strategy followed by, okay, so strategy is about choosing different long-term activities to achieve the purpose set out in the mission statement and ultimately moving towards realizing the vision.
C.
You going with C. Strategy is about choosing long-term activities to achieve the core purpose set out in the mission statement and ultimately moving towards the vision. Okay, but remember, they said which one of the following statements represents the link between the vision and the strategy.
Okay.
So the link wouldn't be, you can't have strategy as being the link between the vision and the strategy, because strategy is the other thing. So I'm going with mission statement here. B. Okay, because it's the link. It's what combines the two. So obviously, mission statement here, just to go back and read the definition, a mission statement defines the core purpose of the organization by broadly stating the reason why the organization exists. A mission statement may be a short sentence or a whole. The mission statement is a wide statement that does not contain figures or targets. See, your figures and targets would be more in terms of the actions or the goals. Okay, or a time limit for achievement. It is rarely changed. The mission statement is divided by organization's top management, broad, in consultation with the management consultants as a tool that guides the priorities that directs the organization's behavior, as personalized by actions of its directors and employees. The benefits, they give that to you here. They give characteristics, guiding the philosophy about direction of organization. Yeah, I'm definitely going with mission statement. To me, that would be the best answer here in terms of being the link. Okay, the link between the vision and the strategy. Okay, the vision is like the big thing. It's like the values, like what you want to achieve long term. The strategy is how you're going to get there. Mission statement would link the two. Yeah, so I like B. There's no real statement in the textbook that actually says link between, unless you found something different. Did you?
No, sir. No, sir, I didn't.
Okay, yeah. I'm leaning towards B there rather than the other two. Okay, question 1 completes. Question 2. Remember, question 2, when looking at questions, always go to the required first to see what they're asking about. Okay, they say set your calculator on 4 decimal places for the calculations of this question and round your answers to 2 decimal places. That's instructions. Show the formulas used in detailed calculations. Okay, so again, just a disclaimer. I don't know if UNISA is going to be very, very particular here in terms of you have to use the formulas, and if you don't use the formulas, they're going to mark you wrong. Or can you use any other method? Because in the textbook, they do give you, in one of the chapters, I think chapter 9 and 10, that was the time value of money. Then there was alternate methods of doing calculations. So they give you alternate ways of doing calculations. I don't know if they're going to be very strict in terms of the marking. Right, so for example, if you get the answer either or, are they still going to mark it right, or do they want it to be formulas? Like how particular are they in terms of their marking? Right, I can't comment on that. I don't know what the marker is going to decide on doing. What I'm going to do is just calculate these answers using the quickest, fastest, easiest method to get the right answer. Okay, so question 2, you've got 6 questions. A says, at what price will it benefit bonds for EU to convert their convertible bonds to ordinary shares? Okay, that's what they're asking you about. It's 2 marks, so it's going to come out of the information in the question. Okay, so let's shrink that. Question 2A. A says, at which price will it benefit bonds for EU Limited, okay, to convert them to convertible bonds, convert their convertible bonds to ordinary shares. Okay, so we're converting bonds, we're converting debt to equity. Okay, they want to know at what price will it benefit them. Okay, right, so Z Limited holds 200 convertible bonds at 5,000 each. Okay, that's the par value. Convertible bonds are issued by bonds for EU. Okay, so it's issued by bonds for EU. So bonds for EU is the issuer. Okay, they're issuing the bonds. So Z is actually holding the bonds, meaning they're the investor. The annual rate of interest is 7%, and the bonds can be converted to ordinary shares at a conversion rate of 160 shares per bond at a maturity date which is after 5 years. Okay. The current market return for similar bonds with a life of 5 years is 11%. Assume a company tax rate of 28%. Okay, the calculated market value of the convertible bonds is that Z Limited has a long-term loan with a book value of 3 million. Okay, that's the long-term loan. This is something different. Z has 800,000 issued ordinary shares that has a current market value of that. Okay, this is looking at their internal stuff. Okay, so for question number 1, all you need to do is look at paragraph number 1. Okay, because paragraph number 1 is look at the convertible bonds. Okay, that can be made into shares. They want to know at what price will it benefit bonds. Okay, so where or when can they convert? So they can convert the bonds into shares when? Bonds can be converted to ordinary shares at a conversion rate of 160 shares per bond at the maturity date. Okay, at maturity date of the bond. Okay, so if we're looking at the maturity date of the bond, remember when the bond price moves from time 0 to time 5, the bond price is going to move towards what the par value is. Okay, so bond price at maturity will be the par value of the bonds. Okay, that's theory. Alright, so looking at this, the bonds will be worth 5,000 each. So total bond value, 200 convertible bonds times 5,000, which is $1 million. Okay, they say at what price will it benefit bonds for EU to convert its convertible bonds to ordinary shares? Okay, so how many shares do they get per bond? They get a rate of 160 shares per bond. Okay, so total shares given, or total shares to be obtained, equals 200 bonds times 160 shares. Gives you 200 times 160 gives you 32,000 shares. Okay, so you would be able to convert your 200 bonds into 32,000 shares. Okay, and obviously those bonds are worth $1 million. Okay, so 1 million divided by 32,000 shares equals 31.25. Okay, so any price higher than 31.25 per share would be a good price to convert the bonds into shares. Does that make sense?
Yes, sir.
Okay, because if
Yes,
the price of the shares are worth more than 31.25, that means my bonds should be converted to shares because those shares are going to be worth more than $1 million.
Yes, sir.
Okay. B. Calculate the current cost of equity. Okay, using Gordon growth. Dividend growth model. Well, dividend growth could also have Gordon growth, depending on what the question gives you. Okay, so Z Limited. Draw a timeline. Okay, so Z has 800,000 ordinary shares issued at its current market price of 29 Rand 20. Okay, and the last dividend was that 1 Rand 50 was the D div. That's div 0. Okay, it is anticipated the earnings and dividends of the company will show a constant growth of 8% per year in the future. Okay, so 8% per year in the future times 1.08. Okay, so that's div 1. They gave you beta, risk-free, and market return. Okay, that's your cap M. Okay, they want to know what is the calculate the current cost of equity. So that must be Gordon growth model. Okay, so PV equals div 1 over brackets R minus G, close brackets equals. Okay, div 1 is 1 Rand 62, which is going to grow constantly. I need a rate though. I need a R. So that's cap M minus my G. Growth is 8%. Okay, so RR equals risk-free 10% plus beta 1.2 times, did they give me the market rate? Yeah, they did. 13 minus 11, no, 10. Close brackets equals
13.6.
13.6 is correct. Okay, so PV here 0.136. Okay, 28 Rand 92. Calculate the current cost of equity for Z by using the dividend growth model. Oh, okay, I see what they're asking for. They're asking for cost of equity, okay, based on the current price. Okay, so what I've done here is I've worked out the price based on Gordon growth, calculate the cost of equity for Z using the capital asset pricing model. So this is actually C. Okay, C is that answer there.
Yes, sir.
Okay, that's C. B is asking you to do this. B is asking you to solve. So they gave you the price. They want you to do this. This is what B is actually asking you for. PV equals all of that. Okay, so let me show you this. Okay, then substitute PV. What is PV? 29 Rand 20. Okay, calculate the cost of equity by using the dividend growth model. Okay, so see, I'm using the dividend growth model. I'm calculating the cost of equity. Cost of equity is denoted by R. Okay, so basically I've got this. Okay, 29 Rand 20 equals that. Okay, so take that to the left. 29 Rand 20 times R minus 0.08, close brackets, equals 1.62. Okay, 29.20 R minus, okay, on the calculator, 29.2 times 0.03 gives you 0.876 equals 1.62. Okay, so 29.20 R equals 1.62 plus 0.76. Equals that. So therefore R equals this divided by 29.20. Okay, 8.5 times 100 equals. Okay, that's what they're actually asking you for. Okay, that's the right answer to B. Okay, so that's B. So B says calculate the cost of equity for Z using the dividend growth model. There's the dividend growth model. That's the answer, 8.54. Okay, then calculate the cost of equity for Z by using the capital asset pricing model, cap M. There's the cap M. See that?
Yes, sir.
Okay. D. Explain the reasons behind the development of the capital asset pricing model. Okay. Cap M, that's theory for cap M. That's looking at your market return. Okay, so I'm going to get theory from the textbook just to give you the right theory, because that's what they'll have in their memo. Cap M, there, background. What did they say? Explain the reasons behind the development of the cap M model. Here's it. Okay, page 200. Right, that's the cap M, that's the background. Calculate the after-tax cost of debt. Okay, after-tax cost of debt. We first need the cost of debt. Where's the cost of debt? Oh, the bonds.
So can I ask you, so didn't they already give that to us? Because they said something that after, it says there in between the two paragraphs, it says the after-tax cost therefore is 12%.
That's for the loan.
That's for the loan.
Yeah, that's for the loan, long-term loan, not for the bonds.
Oh, okay.
Okay, so the bonds we need to calculate using our time value of money. Okay, so we're working out I here. Okay, so use financial calculator. Okay, we look at the bond calculation. So FE is 5,000. 5,000 times 200. Okay, present value was negative. Current market value of the convertible bonds is 1,123,556. Okay, payment. The bond offers how much? Annual interest of 7%. Okay, so 7% of $1 million.
700,000. 7,000. Of $1 million, 700,000. Shouldn't it be? Oh no, shit. 7%. I'm thinking 70%.
Yeah, 7%. 70,000. Okay,
yes.
N is 5 years, right? Yeah, 5 years. Solve for I. Okay, so on your calculator, go to compound interest formula. N 5. I solving for that. PV negative 1,123,556. Payment 70. Future value $1 million. Solve for I. I get 4.2083333792%. Okay, is that correct? Yes, it is. Why is it correct? This bond is trading at a premium. Okay, this bond is trading at 1.1 million. Okay, and the par value of the bond is only $1 million. Okay, the annual interest is 7%. So 7% is greater than the current market return. So for this particular bond, this bond is trading at a rate of 4.21%. Okay, they did give you this though. They said the current market return for similar bonds, similar bonds is 11%. That's the yield to maturity. So are they wanting you to use the 11%? But they gave you information that can actually calculate that because they gave you the price. So this is the yield to maturity based on the current market price. But the question also gives a rate for similar bonds. Okay, which is a bit confusing. Okay, so for E, I'm actually going to show two answers here. Okay, so before tax, cost, after tax, cost. Okay, so option 1 or answer 1 is going to be using this, the 4%. Okay, so after tax would be this times open bracket 1 minus 0.28%. Obviously times 100 to get it as a percentage. Okay, there we go. Okay, that's after tax. Or option 2, or answer 2. Answer 2 would be to use what the question gives you. Okay, the question gave you 11%. Okay, then after tax would just be 11% times brackets 1 minus. Does that make sense?
Yes, sir.
Okay, 7.29%. Okay, so I don't know which one they want here. It's only for 1 mark though. Calculate the after-tax cost of the bond. So it's probably just this for 1 mark, but I don't know because they gave you enough information in the question to actually work out the actual prevailing rate. Okay, because they gave you the market price of the bonds. Right, and then the last question, if Using the table format for mathematical formula to calculate the weighted average cost of capital of Z using market values. Okay, that's easy. So they want a table. Okay, so we're going to need finance, cost, and then the WACC. Weighting, and then the WACC. Okay, so finance. Let's go back to the question. They said use 14% as the cost of equity. What else did they say? That's it. Okay, so they said use 14% as the cost of equity. The cost of debt, though, there. Z has a long-term debt book of 3 million. After-tax cost of debt is 12%. Okay, so again, you have to use one of these answers. You're either going to have to use that answer, or you're going to have to use that answer. Okay, I'm going to use option 2 here because calculate the after-tax cost of debt was just 1 mark. So maybe they do just want you to take the tax off the actual cost that's given in the question. And then you didn't have to do this whole calculation here. Okay, so finance. I've got debentures. No, not debentures, convertible bonds. Okay. I've got a long-term loan. And I've got equity, shares. Okay, so the after-tax cost of debt, maybe I should put that in, after tax. Okay, so the convertibles after tax will be that, 7.92. The long-term loan after tax cost was 12%. And the equity, they said we must use how much? 14%. Okay, so you didn't have to use your cap M as well. See, remember, equity, you could have used your cap M answer. See, but they said use 14%. Does it make sense?
Yes, sir.
Okay. Finance. How much convertible bonds do we have? We've got, well, see, this is the market value. The calculated market value of the convertible bonds is 1,123,556. How much long-term debt do we have? 3 million. How much equity do we have? Okay, equity is 800,000 shares times what is the market price? 29.20. Okay, it gives you that. Okay, so then you have to have total finance equals the sum of all of it. Okay, so the weighting. How am I going to get the weighting? The weighting will be this divided by that. The total gives me the weighting. Do you agree?
Yes, sir.
Okay, then I do the same thing with the long-term debt and the equity. Okay, and obviously if I sum up all of these weightings, it's going to give me 1 because it's 100%. Okay, got that?
Yes, sir.
Okay, so now how do I get the WACC? Well, the WACC component cost equals. Okay, so the WACC would be the cost, which is that, which is after tax already, times by the weighting. Weighting times the cost, weighting times the cost, weighting times the cost. Okay, then I sum up this. This is the WACC for the company based on the different sources of finance. Okay, there we go, and that's the final answer. That's the WACC. Okay, so WACC is just summing up that because they wanted a table. Make sense?
Yes, sir, it does.
Okay. Alright, so now we've covered question 2. Question 3 is looking at organic farming. Let's look at the required though. Calculate the present value factor, okay. Use the NPV method, okay. Determine the accounting rate, okay, and profitability index. Okay, so I can see this is a capital budgeting question. Right, so that's important. I need to know what I've been asked to do. Let's put a heading here. Question 3. Okay, so A, calculate the present value factor for year 3 by using the mathematical formula. Use the percentage return that management requires on capital projects as the discount rate. Okay, if they want the present value factor, and this is for year 3, that means you're discounting for 3 years. So the present value PV factor is going to be 1 plus the rate. What rate did they say we must use here? The discount rate. Percentage return that management requires. Okay, so what return does management require? The top bit, organic farming has excelled in the past years as consumers worldwide are becoming more concerned about the quality and safety of the food they eat. Organic agriculture is considered to be a viable option to most of their concerns. Organic farming needs to satisfy the greater demand for organic products and have identified 2 possible capital projects in order to supply in the greater demand for the organic agricultural products. The first project is to require 3 specialized tractors to cultivate their current vacant land. Second project is to acquire a farming business called OQ. Okay, OQ Limited. The current net present value is 1 million after tax. Okay. The following information for the purchase of the 3 specialized agricultural tractors is available. There's the cost, there's the depreciation, there's the reliable value, there's the useful life. Okay, additional information. Estimated net income. 5% increase in the net income. Okay, that's not a rate. Current tax, fine. Tax authority, okay. 4 requires, there's the return, 21%. Okay, so 0.21, close brackets, to the power, open brackets, minus 3. Close brackets equals. See, this is how you get those present value factors. Okay, so brackets 1.21 open to the power with minus 3. Close bracket equals. See, this gives you 0.0.56447393001. See, that's what you get. Do you see that?
Yes, sir.
Okay, now if you look at these tables, let me show you something. See, this is the old way of doing things. Where's the table? Here's the table. Is this the present value factor? Yeah, present value factor. Okay, have a look at this table. Do you see this? 22, 22 and 20% here.
Yes, sir.
Okay, and then how many years do they want here? 3 years, see?
Yes, sir.
3 years. So if you go along the line here, see, and if you go here, there's it there. Okay, the present value factor for 21% will be the midpoint between those two. Do you see that?
Yes, sir.
Okay, so if I take 0.579 and I add 0.551 equals that divided by 2, I'm going to get 0.565. See that?
Yes, sir.
See, that would have been the present value factor using the table. See, but people nowadays don't use tables anymore because you guys have financial calculators.
Yes, sir.
Okay, but in this question they wanted that. Where's the question now? There's it. No, here's it. Okay, so calculate the present value factor for year 3 using the discount rate of 21%. So A's answer is that. Okay, this is the accurate answer, 0.564. See, when I did it using the table, I got 0.565. So that's why the tables aren't accurate, because they don't provide for rounding errors. Yeah.
Yes.
Okay, but that's it. Or use the PV tables, and then you get 0.565 brackets the middle point of year 3, 21% and 22%. Okay. B. Use the net present value method and determine which of the 2 projects, the tractor's project or the purchase, should be chosen by Organic Farm Limited. Supply a motivation based on your calculations. Okay. Alright, so project 1, which is the tractors. NPV equals, NPV was given in the question, hey? There's it. The current net present value of the purchase is 1,000 after tax. Not 1,000.
1 million.
Got that?
Yes, sir.
Okay, so you need to use cash flows to work out the project 2 NPV. Does that make sense?
Yes, sir.
Okay, so then I'm going to need T1, T0, T2, T3, T4, T5, T6, T7, and so on. Then I'm going to have to provide for the information in the question. Okay, so step number 1 is to get your initial investment.
So can I ask, before you carry on, wasn't that 1 million for the purchase of OQ? Because I think you said the tractors.
Oh, did I say tractors?
Yes,
what did they say in the question? The second project is to acquire a farm. The current net present value of the purchase of... Oh, okay, you're right. Okay, this is the net present value of the purchase of OQ Limited.
Yes, we have to calculate.
We need to do the tractors, so other way around.
Yes, sir.
Sorry. OQ Limited.
Yes, sir.
Okay, that's better. Yeah, so that's the OQ. So this is for the tractors. That's right. Yeah, it's just the wrong way around. Yeah, you're right. Okay, so the information for the purchase of the 3 tractors is available. Okay, cost price 4.5 million. That's for the 3 tractors. Okay, so INV 4.5 million.
Yes, sir.
But there's a realizable value at the end of 900,000. How many years? 3 years. So I can delete this. Okay, so then TCF 900,000. Okay, depreciation per annum is that. So now I need to calculate OCF. So OCF. Okay, so workings for OCF. I need net income. The estimated net income excluding depreciation and before tax. Okay, so EBIDT equals. Okay, so year 1, 2, and 3. $2.1 million. Okay, then I need to less depreciation, less interest. Okay, so the depreciation per annum. Oh, hold on a sec. This says 5% per annum increase in the net income.
Yes, sir.
From the second operational year. Okay, so this needs to go up by 5%.
2205.
And that needs to go up by 5%. Okay, there we go.
252. Yeah.
Right, the current tax is 28%. That's fine. The tax authority allows a 4-year period to claim wear and tear allowance on the cost price of the tractors from the date on which the asset is brought into use. Okay, so let me just think about this. Okay, from an accounting point of view, estimated useful life is 3 years. Okay, so the accountant would have processed depreciation using his method of calculating it. Okay, so that would have been the cost price of 4.5 million divided by 3 years. Okay, that's what the accountant would have processed. Okay, but there's a difference in the tax treatment. Okay, so tax treatment, which is SARS. Okay, SARS would have done this for 4 years. Do you agree?
Yes, sir.
SARS would have taken the 4.5 and they would have divided it by 4 years. Do you see that? Do you see that?
Yes, sir.
Okay, so the company is providing for depreciation at that rate, but SARS will only allow that. Okay, so
Yes, sir.
less interest. Was there interest in this question? 21%. Wear and tear. Cash flows. Yeah, there's no interest here. Okay, so I don't need interest here. Then I'm going to write down less tax. Okay, so do you agree that tax is only going to be on the amount that SARS is going to take into consideration? Does that make sense?
Yes, sir.
Okay, so in year 4, you're not going to have anything there, but in year 4, you're going to have a tax benefit. Okay, so in year 1, tax in year 1 will be your income minus what SARS will allow as a deduction, minus that. Okay, times 28%. Do you see what I did?
Yes, sir.
Okay. Right, and then you'd have the same thing for this. I hope the formula is right. That minus that divide times 28%. Yeah, that's correct. Okay, and then the same thing there. That minus that times 28%. That's the tax. Okay, good. Okay, and then in year 4, you're going to have this. Obviously 0 minus that, but then SARS will allow you a deduction there. So then you have less tax, so then that's a minus, which becomes a tax saving. Do you see that? Okay, so net cash flow, or let's write net income, or net profits. Net profit here would be your this minus your depreciation minus your tax. Okay, there. See that? Okay, and then you add back depreciation. Okay, to get OCF. Okay, depreciation is what you would have processed. Okay, so add back depreciation. Obviously that would just be that. Okay, there's your OCFs. Now you've got it. Okay, did that make sense? Do you have any questions about that?
If you can just go over that tax treatment for SARS again.
Okay, so SARS is going to be writing off wear and tear over 4 years. That's what they said.
Yes, yes, sir.
Point number 3. Okay, so SARS will be allowing you a wear and tear allowance or deduction of only 1,125,000. Do you agree?
Yes, sir.
Okay, but you see, there's a difference between accounting and tax. Okay, because the accountant is going to have this in their books. The accountant is going to have this income with that depreciation because the accountant is using 3 years.
Yes, sir.
Okay. Ooh. Realizable value at the end of the useful life. I forgot about that. Okay. That needs to be taken into the consideration of the calculation. Almost forgot something. Okay, so where's my depreciation? Here's my depreciation.
Yes, sir.
I just need to open brackets here. Minus, what is the residual value? 900,000. Okay, don't forget to take off 900,000. Right, so I need to fix that. Okay, I'm just going to put an asterisk here. Let's do this. That's how I got the two. That's the working.
Yes, sir.
Okay, does that make sense?
Yes, sir.
Okay, so that's the working for the accounting treatment of depreciation. Okay, SARS is going to be using this method. I need to update this as well. Brackets minus 900,000. Okay, that's better.
Okay.
Right, because of the residual value.
Yes, sir.
Okay, there you go. Alright, so that's why I did that. And then obviously net income, this is looking at your accounting. Okay, so accountants are going to be using the net income. That's why I'm using this. So I've got that income minus that depreciation minus that tax. How did I get this tax? This tax is based on the SARS treatment. Okay, so let me highlight that and show a working for it. Okay, this working is did I minus that? Yes, I did. Times the tax. Yes, there we go. Okay, that's it. Yeah. Okay, yeah, it gives me the same answer. Okay, so that's the working to get that. Okay, because remember, your tax. So in other words, the tax that you actually pay is only going to be 336, because the 336 is based on this 2.1 million minus the 900,000, not minus the 1.2. Because that's the accounting treatment of it.
Okay. Sir.
Okay. Alright, and then you add back the depreciation, and then you get those OCFs. Okay, so now I can put those OCFs here. Okay, so there is going to be a fourth year. The fourth year, this 25200 is just the tax benefit that you get in the last year from the wear and tear allowance that you would claim in year 4.
Yes, sir.
Okay. Alright, now we can work out NPV. Okay, Y0, this. Obviously negative.
It's negative 4, yes.
Then this. Then that. Then that. That plus TCF. Oh, be careful though. I need to fix the TCF. The TCF must be after tax. Okay, because you're selling the asset realizable value at the end of its useful life.
Yes, sir.
900. Okay, so I need to do a calculation for TCF. Okay, let's do this at the bottom here. Okay, TCF, 900,000 is the selling price. Okay, we need to know what the carrying value is. Carrying value for the asset is going to be based on the SARS treatment of it. So, carrying value, or okay, let's do the accounting treatment of it. Okay, so, well, carrying value would actually be 0 then. Do you agree?
Yes, sir. Why would it be 0, sir?
Carrying value. Doesn't make sense.
Why would it be 0, sir?
Because it's the end of its useful life. Oh,
yes, okay.
Okay, so if I sell the asset will be worth nothing.
Yes, sir.
Okay. Because it's 3.6 million and then the 900 residual. Okay, so that will be worth nothing. So that means the selling price is 900,000. But in terms of SARS, you've only depreciated the asset for, let's check, for that amount. Okay, so your depreciation was only 2.7. So that means there will be tax on the gain because it's 900,000. So you would be taxed on the gain, yeah. Okay, so the gain tax on the gain would be your let me think about this now. This is CGT. Let's think now. CGT. There will be a gain of 900,000 minus 0. Okay. Tax at 28%. Okay, gives you 252, which is the tax on that, which is the residual. 28% is the residual. What was that other amount here? 252. This was on the. Oh, that was on the carrying. Okay, so those two amounts came out to the same thing. That's interesting. Okay, the numbers tallied up. Okay, but it's not. It's just coincidence though. Okay, because this is the tax on the gain of the asset. So the asset's worth nothing. You sold it at 900,000. So 900 times 28% gives you that tax. So after tax proceeds is going to be 900 minus that. Oh, come on. 900 minus this. Here we go. Okay, so this is what I would put there for TCF. Okay. Alright, so now we can go back and we can calculate the year 3 cash flow. Year 3 cash flow would be the OCF here plus the terminal cash flow. And then in year 4, you're only going to have OCF as a benefit. Okay, there's your cash flows. Right, insert 21% and solve for NPV. See that?
Yes, sir.
Okay, let's check what NPV is. On the calculator, solve for NPV. On my calculator, I get negative 219,124.0591. Did you get the same thing?
Yes, sir.
Management requires a 21% per annum after-tax return. 21% is what we inserted, and we used that. Yeah, that's what we get, negative. Okay, so coming back to the question, use the net present value method and determine which of the two projects, the Tractors project or the purchase of OQ Limited, should be chosen. Supply answers. Okay, so OQ Limited should be purchased rather than buying the tractors to do the project. Or just tractors, full stop. Okay, NPV is positive for the OQ purchase. But negative for the tractor projects. Okay, and that's my working for B. Okay?
Yes, sir.
C. Determine the accounting rate of return. Okay, so that's an accounting rate of return. We need to check what that formula is again. Let me go find that in the textbook. Okay, accounting's rate is based on investors' project's average net profit after tax divided by the average book value. That's what I've got here. Where's the formula though? Let's see. There. Okay, so this is the formula that you're going to need for accounting rate of return. There's it. Okay, so let's do the working. What are we looking at for the tractors? Hey, yeah. Determine the accounting rate of return for the tractors project. Okay, so tractors project. I want the average rate, average net profit. So average net profit equals. Where's the net profit here? Oh, we did the calculation earlier. I can just take it from my working. But this is accounting, hey? So we're going to use this. That's what we're going to use. Ooh, the figures are out now. Oh, let me paste the values rather. There we go. That's better. It's the same. Yeah, it's the same. Okay, so this is what we're going to need. Okay, net income. That's what I want. I only want those 3 years though. Okay, because there's no operating cash flow here. We're not working at operating cash flow. We're working at accounting. Okay, so average net profit after tax would be, open brackets, 564 plus 639 plus 718 divide by 3. Okay, it gives me that. Average investment. What investment did we have here in the project? It was just the cost price, yeah. It was just the cost price was just 4.5 million. That was it, hey? Let's check. Yeah, that was it. Average investment. Average investment must be the average of the... Oh, okay, I'm just checking the theory here. I'm just reading this in the textbook. Let me paste it here as well. Okay, just be careful with this. This is what they say. Average investment equals average of the original investment cost outlay and any residual value at the end of its useful life. Usually 0, but it's not 0 in this case. This is equal to the cost of the investment divided by 2 if depreciation is levied on a straight line basis. Do you see that?
Yes, sir.
Okay, so average investment equals 4.5 million minus any residual value. Okay. Gives you that. Divide by 2. Equals that. Okay, so ARR equals 640860 divided by 1.8 million times 100 equals. Okay, so the average rate of return is 35.6%.
Yes, sir.
Okay, using that formula. Okay, D. Define the profitability index and discuss the relationship thereof with the net present value approach. Okay, so this is theory. Profitability index. I'm going to get the theory from the textbook. Okay. Alright, so theory-wise, this is what profitability index is. Page 132 in the textbook. Okay, that's the definition of it. And then we need to discuss it in relation to net present value. Obviously with the decision criteria. So we need to put that here as well. This bit of theory is important as well. Okay, because the question said define the profitability index. So we define it, there's the definition, and discuss the relationship thereof. So there's the relationship in terms of the net present value. Okay. Does that make sense?
Yes, sir.
Alright, so that was the third question. Question 4 is the one that we actually started with, so we've done that question.
Yes, sir.
Question 5. This past paper seems to be a little bit more challenging than the one we did last week and the week before.
Yeah.
It seems to be a bit more, a lot more calculations in terms of workings, which is good, but you do need to apply your theory a bit more. I feel in this question than before. Before they tested a bit more theory. This one seems to be more calculations. Okay, question 5. Working capital. There's it. What is it out of? Oh, it's a short question. Okay, 24 minutes. A. Just Do Built is a company that supplies building material to contractors and do-it-yourself amateurs. Management need to shorten their cash conversion cycle as much as possible without hurting the operations. Okay, they've taken the actions to reduce the cycle without increasing costs or reducing sales. Fine. Okay, following information is supplied. Current cash conversion cycle, improved cash conversion cycle. Okay, so we've got two different methods. A. The management of accounts receivable and credit sales is an important part of managing the working capital of any organization because the level of credit sales affects the profitability of the organization. Accounts receivable are therefore managed by having a credit policy in place. Okay. Name the 4 areas in which a credit policy should focus, as well as what each area refers to. Okay, so that's theory. Let's go back to our textbook and get the credit policy.
Study Guide 2, page 57.
Page 50?
7.
57. Okay, I got to 185 here. Brought something up here. Okay, here's page 50. Here's page 60. Page 59. You said 57.
Yes, sir.
Credit policy, main interest balance accounts is affected by revenue sales. The four areas. Perfect. You're right. Good. Okay, so 4 marks for each of these. Let's take this information through. Okay. That's literally theory. Okay, so they wanted these 4 points. Page 57. Okay, B. Supply 2 reasons why managing the cash conversion cycle of any organization is important. Yeah, well, that's easy. That's obviously you're improving cash flow. Okay, inflows better than outflows. Okay, let's just get the right theory from the textbook just so you've got everything that they require. Did you have a page reference for this as well?
No, not for this one. I didn't.
For this one, okay. Let's check. Supply 2 reasons why managing the cash flow is important. Okay, so the first thing would be to describe what the cash conversion cycle is. Okay, so this is the definition that the textbook gives you for the cash conversion cycle. Okay, we're looking at why is it important to manage it. Well, you would want to reduce your inventory, and you would want to reduce your debtors collection, and you would want to pay as late as possible.
Yes, sir.
So the cash conversion is a cycle because it contributes to the, there we go. I'm going to add this theory as well to your answer here. Okay, so let's talk about this cash conversion cycle on page, what page is this now? Page 80. Okay, is there anything else that we could add to the solution? Maybe, let's just check. No, I think that's fine. You don't have to describe the formula, I don't think, because this was just looking at theory. Yeah, I don't think you need to show the formula here, so it's probably fine as is. Okay, so obviously you want to shorten the cash conversion cycle. So 2 reasons why managing the cash conversion is important. Well, maybe we could talk about something more general. Profitable companies can go bankrupt. If they don't manage cash flow. Unprofitable companies can continue to operate if they manage their cash flow. Okay, that's just something additional. You can maybe stick to the theory in your textbook. I'm just providing some other reasons why the cash conversion cycle is important.
Yes.
Okay, it's also a way to manage and analyze cash management. Okay, so you can see more information for decision making. Okay, useful decision making. Right, C. Calculate the RAND values of the benefit from improving each of the following elements in the cash conversion cycle. Convert relevant known formulas in order to calculate the unknown values that are required. Okay, inventory, receivables, payables, and total value of benefit net working capital. Okay, so that's looking at that method, that improving credit policy. Let's go back and find that example just to get all the formulas. Policy. Do you have the page number there by you in terms of the example where you had a trade policy?
What the credit policy does from page 57, sir, and then into the example on page 59.
Okay, so is it page 57?
Yes, that was for the credit policy.
Yes, that's right. That's what we're looking at.
Okay.
Yes, there we go. Okay, payable days. We've got. Where's the change though? Okay, I think it's actually more page 75, not page 50.
Yes, sir.
That's actually the one. Let's just find the change in policy. There's this triple C again on page 80. Cash conversion cycle. Oh no, this was looking at long-term and short-term financing, the aggressive and conservative. Okay, they don't actually give you a nice example in this textbook for it. That's a pity. But you do need those equations. So let's get the equations rather, which is the ratios in the first. Let me get the ratio. So inventory. Okay, so obviously inventory I'm going to calculate from my inventory conversion times. That will be my inventory turnover. So let's go to the ratios.
Page 32, sir.
Page 32. Is that the inventory formula?
From page 31.
Asset turnover, EBIT, current ratio, liquid assets, inventory, days. There we go. What page is this? 31.
Yes, sir.
Okay, good. So we've got the formula. Take it. Paste it. Okay, so the first thing they want you to calculate is inventory, but for which years though? Calculate the RAND values of the benefit of improving each of the following elements on the cash conversion cycle. Calculate the convert relevant known formulas in order to calculate the known values that are required. Okay, so inventory. Let's first get the inventory, which is number 1. That's the first part. Okay, we'll look at the other parts just now. Okay, so inventory. Okay, I'm looking for current, obviously. Current and then proposed. Alright, so with the current inventory conversion time, 68 days. So 68 equals inventory over cost of sales times 365. Solve for inventory. Inventory is going to be 550,000 divide by 365 times by 68. Okay, there's the inventory. Okay, now we've got one figure. Right, we need to do the same thing for the proposed. The proposed is 62 days. And the cost of sales is the same. Okay, fine, great. So we just need to save, we just need to change the 68 becomes 62. Alright, there's my inventory for the proposed. Okay, got that.
Yes, sir.
Okay, let's go to number 2 now. What's number 2 asking for? Receivables and then payables. Okay, receivables and then payables. Okay, so I need the formula for receivables and payables. Okay, there's the one formula. Okay, current and proposed again. Okay, current. Receivables for current. I'm trying to work it out. Oh, they gave you the receivables for the original period. Do you see that in the question? They gave it to you. 631,233. Divide by credit sales. Credit sales, question mark, 80% of sales. So brackets, 8 million times 80%. Times 365. 36 days. Yeah, that's correct. See that? That's right. Do you see that? They gave you the answer in the question.
Yes, sir.
Okay, the proposed they didn't though. Okay, so what's the proposed? The proposed is 30 days. Equals, question mark here, over 8 million times that. So that's right. Okay, solve for receivables. Okay, so if I solve for my receivables, I'm going to get brackets 8 million times 0.8, okay, times 30 divided by 365 equals, gives me that. There's my receivables for the proposed. Okay, so now I've done that. Now I need to do the payables. Right, current and proposed. Again, the question gave me an answer. Let's see what you get though. 738356 divided by open brackets. Credit purchases, oh, don't need to open brackets. Times 365. Okay, 50 or 60 days. 55 days, yeah, that's right. See, it's correct. Same as the information in the question. Do you see that?
Yes, sir.
Okay, so now proposed is 60 days. So I'm looking for payables. Payables equal 4900000 times 60 divided by 365 gives you that. There's your payables. Okay, now I've done that. Okay, what else did they ask you to calculate? Total rand value benefit in net working capital due to the shortening of the cash conversion cycle. Okay, so net working capital. Did they tell you anything in the question here about the change in net working capital? Let's see. They gave you the annual sales, the credit sales, the credit purchases, inventory, accounts receivable, trade payables. That's all they gave you. They said calculate the rand values of the benefit from improving each of the following elements. Okay, total rand value benefit in net working capital. Okay, that's the total rand value. So we need to look at the rand benefit of improving the following elements. Okay, so inventory. Alright, so looking at inventory, let's go back to inventory. Benefit. Let's do a column here, benefit. Okay, so I want to know what the benefit is for all of these. Alright, so current inventory was that. Proposed inventory is that. Better or worse? Better, right? Current is this, minus proposed is that. Okay, so less inventory held. Benefit. Does that make sense? Okay, so current inventory is 1.02. Yes, proposed inventory is 934. Benefit, that's the benefit. A saving. Make sense?
Yes, sir.
Okay. The receivable. There's the current. There's the proposed. Okay, so there's a benefit here as well. 631,233 minus that. Debtors decrease. Benefits. Payables. Payables went up. Oh, hold on a sec. If payables go up, is that a benefit? Let's think about this.
No, that's not a benefit.
If your payables go up, that means you've got more liability, but it's in a term of cash flow. That means you've got more financing. They've given you more time to pay, but that's not what they're looking at. They're looking at the rand value of the benefit. Yeah, so this wouldn't be a benefit. Payables increasing. It's a benefit in terms of cash flow, but not in terms of rand value, because you've got more of a liability. Okay, so this minus 738,356. Okay, that's a negative. Why is it a positive? Oh, wrong way around. 738,356 minus this. Okay, there we go. Right, what else? That's all we've got. So, net benefit is the sum of those three amounts. There we go. There's the net benefits. Okay, so calculate the rand values of the benefit of improving each one of the following elements. Okay, we've done that. We've done that. Total value of the benefit in net working capital due to the shortening of the cash conversion cycle. That's the total net benefit. So this is number 4. Okay. If the above 3 changes are made, then the net benefit in working capital is plus 258,493.10. Okay, see that?
Yes, sir.
Okay. Alright, D. Just do Bolt feels that they want to reduce their cash on hand as low as possible. Okay, cash on hand as low as possible. Advise them by listing 3 reasons why enough cash should be held to avoid the risks that an organization can face when having too little cash. Okay, that's obviously liquidity problems. Okay, it's not being able to meet your obligations, not be able to pay for inventory, not be able to take advantage of certain opportunities. Okay, but let's get the textbook answer for that. Where would we find this? Cash on hand. Let's search for that.
Page 65.
Oh, do you have it?
Yes, sir. It's on page. It starts on page 65.
Brilliant.
And ends on page 66 of the second textbook.
Yeah, perfect. You've got it. Yeah, you've got it. Nice. Okay, page 65 is correct. Okay, there's 2 reasons, and then the rest continues here, another 4 reasons. Yeah, I see opportunity. Okay, yeah, I thought so. It's quite common to see questions like this. Okay. Right, is that it? Looks like it. Great. And now we've completed another past paper. Any questions about this one, MayJune 2016? What we did?
We went actually in a lot of detail and step by step with this one. There were quite a lot of calculations as well.
Yeah, this past paper did seem to be a little bit more challenging than those other 2 that we did, purely because you had to apply a lot more of the theory.
Yes, sir.
Okay. Anything else? Happy?
No, so far no, sir. Good.